course, we've been getting updates on the economy, spearheaded yesterday, or Friday, I should say, by the big surprise jobs report there, showing that unemployment actually ticked down. But a lot of questions are being asked about what the nuances of that report says about the current state of the economy. I want to kick off today's show with the discussion on just that. Joining us right now is Jason Furman, the former Council of Economic Advisors Chair under President Obama and Harvard economics professor. And Jason, good to see you again. I want to kick off this conversation. We'll get into the JOLTS data that we got in a little bit, but just want to kick off with the thoughts that we heard today from Deutsche Bank, mostly highlighting a couple nuances from that jobs report, notably that they said they were surprised how rehiring was not as robust as you'd expect if employers were, in fact, rushing to rehire workers. Their main harp I want to show in this chart, which shows unemployed people for less than 5 weeks, were just about as likely to be rehired in May, a 38% chance, as they were in February before all this began. The same probability, so not exactly what you'd expect to see if companies were in a rush to rehire. So what do you make of that, and maybe what the jobs report maybe hid about the speed that investors should be expecting about this recovery?
Yeah, the jobs report showed that the economy hit bottom in April. It also showed that the economy was still very, very deep in the hole in May. Jobs were added, but we're still 20 million jobs short. The unemployment rate came down, but the unemployment rate is still between 13 and 17%, depending on how you count it.
Yeah, and when you talk about how you count it, obviously there's a lot of things that go into a headline number of the unemployment rate. Obviously, labor force participation matters quite a bit when you're calculating that. So how does that kind of tie into what you're seeing in maybe employees that got laid off and just disheartened at actually trying to find work again until maybe things fully come back to normal?
Yeah, you saw an unusually large decline in labor force participation in April and May, even a large decline relative to how much unemployment there was. There's different views on what's causing that. Probably the primary factor is, what a terrible month to look for a new job. And you wouldn't necessarily want one right away. But certainly high unemployment insurance is, probably reducing some job seeking. I don't think that's the most important factor, but that's part of what's going on. But, the biggest concern in the numbers was even if everyone on temporary layoff was rehired, we would still have a recession level of unemployment.
Yeah, and you highlighted that last time. Of course, the peak in unemployment back in that Great Recession was 10%, still sitting above 13, according to the latest report. So, when you dig into that, you mentioned maybe potentially the unemployment benefit there. That's expected to expire. It will expire at the end of July. It becomes very important now what the next policy proposals there are going to be in the next stimulus wave. We've heard Republicans, Democrats going back and forth. Notably, it seems like a bonus to get people back into the workforce might be what Republicans want to push for, as well as liability protections. So what are you seeing as instrumental in maybe adding some fuel to the recovery here, and what both Democrats and Republicans might be able to agree to?
Yeah, I don't think labor supply is the biggest issue. We did see in the JOLTS data, which gives you the job turnover numbers, that the number of new openings fell. So there were fewer jobs. Surprise, surprise, in April. But, a little bit of impetus to get people back to work. There's nothing wrong with that. And certainly if that's what the Republicans want, that would be a perfectly great compromise to make, to have effectively like a hiring bonus for people who are hired back. On liability, I think the biggest issue with liability is that we don't have very much in the way of workplace safety regulation here. And you sort of have a choice. You either have liability or you want to make sure workplaces are safe. If you don't do either of those, it raises some concerns.
Yeah, the JOLTS data was pretty interesting in what we got this morning, showing that the number of job openings, as you noted, fell down by about 5 million. But more importantly, I think, to me, when we think about the just massive swaths of people in this country that are now looking for a job, when you look at that, it's roughly about 4.6 unemployed people per job opening. up from less than 1 in February, reached a peak of about 6.8 during the financial crisis. So what does that say about how the situation looks today relative to what President Obama may have been facing the recovery back in 08, 09 and beyond?
Well, no one's ever faced a month like the month of April, where 15% of the U.S. economy was shut down. It's just such a unique month in our economic history, with disposable personal income went up that month, consumption went down that month, jobs went way down that month. Reported average hourly earnings went up because a lot of low-wage workers stopped working and dropped out of the sample. So just the data for the month of April is just, it's just sort of freakish.
Yeah, there's a lot of weird anomalies to discuss. But one of the things that has been constant, I guess, through all of this has been the way that the Fed has been battling to keep things in check. I mean, we can talk about what they've done, but most notably, they've expanded the scope of its Main Street lending program just yesterday, basically raising the max loan limit there, extending loan terms to 5 years to get people to actually take up that program. We're going to hear from Jay Powell tomorrow. What do you think maybe needs to be done? Is there more that needs to be done on the monetary side? I mean, it seems like a lot of the pressure has fallen on the fiscal side here, as it's been a while since we've seen new updates out of Washington, D.C., and it sounds like Chair Powell is content to basically push the onus on that side of the stimulus in the next wave.
Yeah, I mean, I think the Main Street lending program, those were baby steps the Fed took yesterday. They still, and it requires the Treasury to instruct them to do this, they still need a lending program that is longer term loans, lower interest rates, less repayment up front. And ultimately, the Treasury needs to be willing to take a risk that it's not going to be fully repaid, because these loans have, large economy-wide benefits. In terms of monetary policy more generally, the Fed can say whatever it wants, but people know that interest rates are going to be at zero for a while. Forward guidance, I don't think, would add a whole lot to that. Yield curve control, I don't think, would add a whole lot to that. The pace of asset purchases can affect some markets and matter, but right now the main game is not monetary policy, which is set where it is, but fiscal policy and what happens in Congress.
Yeah, and I think that's kind of interesting, just again to highlight some of the things that you've been telling us over your last few appearances here on the show. We heard similar messaging coming from former Fed Chair Ben Bernanke, talking about the way that right now a lack of that fiscal stimulus is impacting the states. You've warned before that it's a mistake that was made back in the Great Recession that would want to be avoided here, in that you have states trying to manage their budgets, municipalities cutting back at a time that the federal government is trying to stimulate the economy. So what, again, are the lessons there, maybe, again, just to drive home the point that fiscal stimulus does become increasingly more important here?
Yeah, I mean, this is the one tool in the toolkit that we haven't really taken out and used to any degree yet. The state fiscal relief in the last recession was studied very closely, and it added at least $1.70 of GDP for every dollar that was spent. So it was very high multiplier, high bang for the buck. But it's not just what it does for GDP. It's, you want teachers in classrooms in September. And, it's not fiscal irresponsibility on the part of states that's preventing that from happening. It's just a drastic fall in tax revenue. And so, this needs to be the top priority for the next bill that Congress does.
Yeah, as a teacher at Harvard right now, I'm sure you are also pushing for things to be back to normal come September. But when we look at, I know you're not a stock picker. I know the market's not necessarily what we booked you on to talk about. But when we talk about maybe the Fed's actions here and what we're seeing play out now in the market, I'd be curious just to get your take on maybe some of the increasing speculation that we've seen. A lot of people are talking about it now. When you look at small trader action, making up more than 50% of the total volume last week. That would be the highest since 2000, according to Market Watcher Sundial Capital Research. You got Hertz advancing by more than 1,000% after filing for bankruptcy. There's a couple different examples we can point to. There's also the percentage of unprofitable unicorns coming out in the IPO market right now. I mean, is there any risk that maybe some of the Fed actions here might be more stoking some speculation that we haven't seen in a while? I mean, I know that was a fear back in the Great Recession, and a lot of investors highlighting that. But I'm just curious if you've seen anything to that effect that might be raising some alarm bells in your head.
Look, I have some alarm bells about stock valuations now. A couple of weeks ago, I was able to defend them. At this point, it's becoming more and more puzzling to defend them. But I wouldn't blame the Fed. I mean, the Fed can't, control the stock market from day to day. The Fed can and should be focused on credit markets, making sure they're functioning, making sure that businesses have access to loans, that households can get mortgages, that those rates are stable or coming down. The Fed has done a great job of that. And, I don't think it should be trying to second guess or control equity markets. And I think it's a bit rich for traders to all be blaming the Fed for their own actions.
If not the Fed, then, I mean, what would you attribute some of those alarm bells that are ringing, and what are they? If not the Fed, what's really causing some of those in your mind?
Markets can get ahead of themselves. They can get overly optimistic. And right now they're very optimistic about the pace of economic recovery. And I think there's more risks to the economic recovery than they think. We did the easy part of growth in the month of May. The harder parts are ahead of us. And so, I think it's a mistake to extrapolate from what we're seeing in the economy right now to assume we're going to stay on that trend line over the next year. And I think some markets might be making that mistake.
Yeah, I mean, it seems very much so that might be what's going on. And you consider we had a 1,000-point jump on the Dow after we got that jobs report. I guess if there was one warning to people who might be reading too much into that, obviously we just talked about it. But when you do look for the year-end recovery, a lot of people saying that we will, as you noted, hopefully get that full return to employment. But even then, there are still risks. So what might be the warning there in terms of how long this road will be, and how maybe some of the data points that we've gotten in the last few weeks might cause a rush to being overly optimistic?
Yeah, I mean, the issue is that, it's very easy to turn the lights back on and bring back the first set of employees. The last set of employees aren't going to go back to the businesses that they left. They're going to have to find new jobs. That's much, much harder. And that last set, is that going to be, 1/3 of all employees, half of all employees, 2/3 of all employees? We don't know. And not very much about May answers that question. And that's why, I just wouldn't overly extrapolate from 1 month's data the trajectory that we're on.
Yeah, well, we got NASDAQ at all-time highs, so something to note there. But Jason Furman, always appreciate you coming back on to chat all of this. Thanks again for taking the time.
Great talking to you.